Hey guys, what's going on? Welcome into the video. So we had a huge rally in the stock market last week. I have some important things to get to in this one. So overall, this will be more of a quick video and be going over my broad market thoughts and expectations next, along with some technical scenarios, bull and bear, that I'm watching for moving forward. We're also going to be talking about some fundamental risks to be aware of as well in the tech sector. So without further ado, let's go ahead and get into it. So starting out, last week I laid out a possible technical bull case and bear case on the S&P that I was watching for moving forward, and the bull case played out pretty much to a T as the market broke out of this inverse head and shoulders pattern that we talked about last week. So now let's get into another important pattern that has built out, how to trade it in the week ahead, along with some different scenarios that I'm watching out for the week and weeks ahead. So the next important pattern to keep a close eye on is this wedge pattern that has been building out for about 6.5 months, which connects from the August swing high and the October swing low. The resistance on the upside trend line of this is going to be about 41.60 for the week ahead, and I have this marked with those pink trend lines on the chart. So along with the S&P getting close to that major resistance, it is heavily overbought on the RSI. Here I marked each time that it's been overbought on the 4-hour time frame, and as we can see, this always results in at least a small pullback and sometimes will result in a short-term top. So before anything else in the week ahead, we should be expecting some red and at least a small pullback next week. Alright, so getting into the core chart, the breakout last week was triggered by the break above this white trend line, which was the neckline of the inverse head and shoulders pattern. So to keep it simple moving forward, bulls are well in control of the trend, and we should expect this to be in more of a buy the dip market as long as it holds above that breakout point at about 40.60. But be aware that risk could come right back to the market on a failure below that point. Alright, so now let's lay out some scenarios to watch for moving forward. So starting out with the bull case, I would expect that small pullback next. Maybe the dip gets bought at about 41.20 before continuing higher and testing that major spot at 41.60. From there, there's probably a good chance for a larger pullback to start, which I mapped out in this scenario to pull back and retest that 4,060 previous breakout level as new support. The heavy majority of big and important breakouts will come back to retest the breakout point as new support. So from here, bulls would want a very strong reaction off that retest, and from there could break out above the pink trend line to see the next leg higher and have a good shot of making up to that next major 42.50 level above, which would be the next upside target if that 41.60 trend line is broken. Alright, so next, the possible bear case that I would be watching for would be to start out relatively the same, with a small pullback next week, a move higher before a strong reaction off that trend line at 41.60 that leads it back to retest that previous breakout level. The big difference here would be a weak reaction from buyers at that point, and a fail below that level at about 40.60 would get the real bear case underway, where it could then make its way towards the levels below. Now, of course, these scenarios will not play out exact, but it's important to go through exercises like this and think about how price could react at each key level, and which key levels are essential to hold for the uptrend to stay intact, or it could lead us into a new downtrend. Okay, so now let's talk some about what may be going on behind the scenes of the market right now. And I personally think we've been seeing a lot of window dressing from funds. Tech stocks had huge performance in Q1. So what does that mean? That means funds were forced to chase these tech stocks so they can show that on their Q1 books to keep their clients happy. And chasing these stocks higher will also pump up their quarterly performance. Moving forward, it'll be super important to watch Nvidia, Apple, and Microsoft, which have been pretty much the poster childs of this tech pump. There's a good chance we see some big sector rotation in the second quarter, and if so, we will see declines in tech stocks, especially those three, which are overextended, trading for historically high multiples. Take a look at this chart. The current technology price to earnings ratio premium versus the S&P 500 is now up to 38%, which is much higher than we saw even at the 2021 highs. Now this is another supporting factor of why we should see some big sector rotation moving forward. And finally, behind the scenes, overall market breadth has not been great, and pretty much the mega cap tech stocks have been what has led this market going higher. The NYSE new highs chart is weak and is far off from the February highs, and the Nasdaq looks a little bit better, but still well off those highs from early February, which are negative and bearish signals behind the scenes for the overall broad market. Some historical charts also continue to urge caution as well. This Nasdaq rally has been near identical to the one from June through August, and this is another good reminder from Hedgeye Research on the analog from 2000 to 2002. During the crash, there were 11 rallies of more than 10% and 4 rallies that were between 28 and 49% on the Nasdaq. In a recent video, I also talked about the historical chart from the 2008 banking crisis, which could relate to where we are now. After Bear Stearns collapsed, the market actually responded with an initial rally, and the real pain came later in the year. This chart from RIA also lays out this historical chart as well, and it's up to us traders and investors to decide whether this could be a repeat of history or if this time around is much different. Now, if you ask me, I'm definitely bearish on fundamentals currently, with a lot having to do with valuations and where rates are currently at, and I do expect a downside to come in the future. If the bear market has already ended and we're in a new bull market, this will be the most expensive start to a bull market in history, and upside overall will likely be limited in the future. But my bearish fundamental opinion is exactly that. It is just an opinion and not something that I trade off of on the day-to-day. The easiest thing to do is always just follow price and technicals, and until that proves bearish price action, there's no reason to trade that way. Always just keep it simple and trade with the trend. So that is everything that I'm watching for in the week ahead, technically and fundamentally. Hope you all enjoyed, hope it provided some value to you. If so, make sure to hit the like button and subscribe button down below. It helps me out a lot, and I would greatly appreciate it. For anybody interested in joining the private Discord chat, that is the first link down in the description to get my personal trade alerts, nightly watch list, and you can ask me any questions in there. And thanks for watching. I will catch you all next time, and peace out.